Hi everyone, welcome to my mind mapping video for corporate finance class at IPMI International Business School, class of September 2021. My name is Maya Saptari, and without further ado, let's begin this mind mapping, shall we? But before we start, I would like to give an acknowledgement to our lecturer, Professor Roy Samble. Pak Roy is a very funny and very insightful person, always encourage us to not be afraid to make mistakes. And during the 8-week duration of this class, I'm sure I've made plenty of mistakes. So the objective of corporate finance class is to give us problem skills in finance from the point of view of management, which is internal, and investors, which is external. As Pak Roy mentioned at the beginning of every class, the brief philosophy of learning by Confucius is, I hear and I forget. I see and I remember. I do and I understand. Therefore, we are always encouraged to do, and that's what makes us grow. So let's begin our mind map towards the week one. So here is the big picture of the mind mapping of 8 weeks. And let's go to the very beginning to week one. In week one, we learn about the introduction to finance management. So what is financial management? It is an optimal orchestration of internal and external financial resources towards significant and sustainable value creation. In financial management, numbers and figures are important, but the story and the people behind the numbers are equally, if not more important. So what are the goals of financial management? There are 4 objectives. Number 1 is basic objective, which is for profit and wealth maximization. Number 2 is operational objectives, which is timely availability of requisite finance and most effective utilization of finance, including safety of investments and growth of the enterprise. The 3 is social objective, which is the timely payment of interest, wages, and tax, also payment of reasonable dividends, fair settlements with suppliers, and maintaining relations with financiers. And the last one is research objectives, which is researching into new and better sources of finance. You may wonder, what is there to manage? Well, there are capital structure, working capital management, asset structure, revenue management, cost management, cash flow, growth management, and risk management. During this week, we also learned the cornerstones of corporate finance, which is the core of value principle. Value is driven by returns on capital and growth and cash flows. Conservation of value principles. You can't create value by rearranging claims on cash flows. Expectations treadmills principle. The more investors expect of your share price, the better you must perform to keep up. And base owner principle. A business value depends upon its owner's capabilities. With this, we are being introduced to an important figure, Mr. Ramcharan. You can see his picture here on the top left. Hang on, is this the same guy as the Bollywood actor? I don't think so. Ramcharan here stated that there are 5 business essentials that every business must pay attention to be successful, which are cash, profit margin, velocity, growth, and customer focus. Next, we also learned the classical issue in finance management, which is the principal agent problem. Essentially, principal agent problem is a conflict of priorities between the owner of an asset and the person to whom control of the asset has been delegated. The problem can occur in many situations. For example, relationship between a client and lawyer, or relationship between stockholders and CEO. In the following week, we learned about the type of investments there are in the market, namely mutual funds, government and corporate bonds, shares of publicly listed companies, shares of private companies, asset-backed securities, real estate investment trusts, commodities such as gold or cocoa, etc., foreign exchange or derivatives like forward futures or options. So after getting familiar with this type of investments, please beware of investment fraud out there, okay? Next, we also learn about the compounding, which typically refers to the increasing value of an asset due to the interest earned on both a principal and accumulated interest. This phenomenon is a direct realization of the time value of money concept. Time value of money is the concept that sum of money is worth more now than the same sum will be at the future date due to its earning potentials in the interim. This is a core principle of finance. The sum of money in the hand has greater value than the same sum to be paid in the future. This concept is also known as compound interest. You may hear a lot of this concept from Mr. Warren Buffett. I'm sure you've heard a lot about the guy, right? Next, we also took a deep focus on capital budgeting concept. What is capital budgeting concept actually? When we are about to invest on something, we ought to make a calculation on whether the investment is a good bet or not. And one of the ways to calculate that is through capital budgeting. Through capital budgeting concept, we can estimate expected future cash flows. We could evaluate the project based on capital budgeting evaluation criteria. We could decide whether and which project is good or bad. And let's say if there are two or more projects, it could be mutually exclusive or independent. There are four different methods for capital budgeting. One is payback period. Number two is net present value or NPV. Next is profitability index or PI. And the last one is internal rate of return or IRR. Of all the four methods that we learned, the net present value seems to be a better method because of the conservatism principle. Meanwhile, payback period has a lot of weaknesses. Namely, it is subjective, and it doesn't consider time value of money, does not consider required rate of return, and all the cash flows from the project. So we assume that NPV is the better method of all four because it follows the conservatism principle. So next, we also learn about the tools for market analysis in the financial market. So there are two main analyses. Number one is technical analysis. Technical analysis is a trading discipline employed to evaluate investment and identify trading opportunities in price trends and patterns seen on charts. Technical analysts believe past trading activity and price changes of a security can be valuable indicators of the security's future price movements. Technical analysis may be contrasted with fundamental analysis, which focuses on a company's financial rather than historical price patterns or stock trends. Therefore, technical analysis is usually used for more of a short-term investment. Number two is fundamental analysis, which is a method of measuring securities' intrinsic value by examining related economic and financial factors. Fundamental analysts study anything that can affect the security's value, from macroeconomic factors such as the state of the economy, industry conditions, to microeconomic factors like the effectiveness of the company's management. For stocks, fundamental analysis uses revenues, earnings, future growth, return on equity, profit margins, and other data to determine a company's underlying value and potential for future growth. All of this data is available in the company's financial statements, balance sheet, income statement, and cash flow. With those information, fundamental analysis also measure ratios, and in ratio analysis, multiple ratios can be used to measure profitability, liquidity, activity leverage, and market. Thus, fundamental analysis is usually being used for more of a long-term investment. So one of the metrics of or ratios that investors consider is the dividend policy of the company. So should company pay dividend to the shareholder on a regular basis? The other choice would be to retain its earnings used for the development or additional capital investment. We discussed that it is good that a public company to pay dividend to its shareholders regularly because it shows that the company has a healthy cash flow and the cash flow is truly available. It will gain confidence of potential investors to put their money in the company, and it will increase the stock price in the long run. In the following week, we discuss about the risks, which are the systematic and unsystematic risks, and also the stock correlation with the market. We use beta, which is the measure of the volatility of a security or portfolio compared to the market as a whole. Beta is used in the capital asset pricing model or CAPM, which describes the relationship between systematic risk and expected return for assets, which is usually stocks. Capital asset pricing model is widely used as a method for pricing risky securities and for generating estimates of the expected returns of assets, considering both the risks of those assets and the cost of capital. So capital asset pricing model describes the relationship between the systematic risk and expected return for assets. Meanwhile, the weighted average cost of capital, or WACC, represents the firm's average cost of capital from all sources, including common stocks, preferred stocks, bonds, and other forms of debts. The weighted average cost of capital is a common way to determine required rate of return because it expresses in a single number the return that both bondholders and shareholders demand in order to provide the company with capital. A firm's WACC is likely to be higher if its stock is relatively volatile, or if its debt is seen as risky because investors will demand greater returns. Next, we discuss about the capital structure of a company and how debt or equity capital structure will affect the value of the firm. The Modigliani-Miller or M&M states that the market value of a company is correctly calculated as the present value of its future earnings and its underlying assets, and is independent of its capital structure. With certain assumptions in place, it is irrelevant whether a company finances its growth by borrowing, by issuing stock shares, or by reinvesting its profits. The assumptions are perfectly efficient if there is no taxes in the market, no financing, and there is no financing cost, because that is cheaper than equity and will improve the value of the firm to a certain level. Of course, if the debt is going beyond it, there will be financial distress, which will have impacts not only on the financial reports, but also to the morale of the employees and the company as a whole, including the pressure, volatility, and sustainability concern of the company. Next, we also learn in depth about the leverage buyout or LBO through the case study of RJR Nabisco. A leverage buyout, or LBO, is the acquisition of another company using a significant amount of borrowed money through bonds or loans to meet the cost of acquisition. The assets of the company being acquired are often used as a collateral for the loans, along with the assets of the acquiring company. So as we learned from the RGR Nabisco case, the value creation created by the LBO are the debt ratio, which is relatively low, the optimizations of cash flow, changing in management from the so-so performance, whereas most people are mostly in the comfort zone, and the elimination of conglomerate discount in valuation because of the complexity. The simpler, the better. So from this case study, we also learned that LBO is prone to ethical issue and principal agent problem. So next, we're going to talk about this ethics issue and how it affects a lot of decisions in our financial life. So what makes people do the unethical thing? So you can see here, there is the fraud triangle, which is the perceived pressure, which is the financial pressure of greed, addictions, poor credit rating or cash management, also work pressure, dissatisfaction with pay and overlook for promotion. Next is perceived opportunity, which is weak internal controls, ineffective monitoring of controls, and assets susceptible to fraud, and the rationalization, the thoughts that say, I'll pay it back, or I deserve a pay raise, or it's for a good purpose. So is greed good then? Gordon Gekko from the movie Wall Street seemed to think so, as you can see here in the picture. Greed, for lack of better word, is good according to Gordon. But please note that the greed that he meant here is not greed with its literal meaning, but more to the hunger and thirst on keep on growing and developing and not feel complacent. So yeah, in that sense, we can conclude that greed is indeed good. Next, we also learned about the foreign exchange market. Previously, we used gold standard, but later on, it is outdated and has evolved to agreements on fixed exchange rates to a floating rate system. Indonesia used to adopt fixed exchange rate, and some countries are also still using this method today. Meanwhile, floating rate depends on the market mechanism. The rule of supply and demand of the currency, the macro relations will influence foreign exchange rate. Lastly, we discuss about the market efficiency. Market efficiency refers to the degree to which market prices reflects all available relevant information. If markets are efficient, then all information is already incorporated into prices, so there is no way to beat the market because there are no undervalued or overvalued securities available. From the investment simulation class that we did in the class, it can be seen that usually 7 out of the 10 are following the market trend. So only 3 out of 10 are doing better than the market. So much so that can be concluded because we don't know future events or future news which will determine future market price, hence the random market. Therefore, we always have to remember to diversify our portfolio and not rely 100% on the logics and rational. So those are the big picture of what we have learned for the past 8 weeks in the corporate finance class. I hope this mind map will be useful to you, the viewers of this video. Don't forget to comment and like this video. This is Maya signing off. Bye-bye.